Welcome back. My name's Aaron. This is Czar Finance, episode 27, Insurance. So when it comes to the word insurance, insurance is risk management to potentially lower the risk of your financial losses or hardships that you may occur to your savings or checking account. And so that way it doesn't impact the fact that you could go bust or go bankrupt in regards to covering, an activity that you may have done or somebody else that may be doing something at a high risk level. So basically insurance means to cover yourself or protect yourself. It's important to have insurance because you don't want to be doing risky things and get hurt and all of a sudden you don't have insurance and then you're going to get slapped with a huge bill from the hospital or something like that, which could cause you to go bankrupt and pay those fines later on or go to court or make you go bankrupt in the long run. So insurance basically kind of covers you from those sort of things. So now basically, insurance is basically risk management. What that means is you want to assess your, how risky you are. What kind of job do you have? Are you in a high risk scenario? Are you in the military? Are you a police officer, or maybe you're in a bomb squad, maybe you're a firefighter or a police officer or something like that. In a high risk scenario, you might want to have a higher life insurance type of a thing. So if something were to happen to you, your family or you will not have significant burdens when it comes to potential paying out for death or something like that. You know what I mean? So you won't have those. Your parents or your significant other will not have to be burdened with the amount of debt should something happen to you. Okay, so you're managing your risk. Insurance basically is it's managing the types of injuries you might have. Whether it's physically to you if you're in the hospital or something like that, whether you're in an auto accident, so you might want to have auto insurance. There's so many different types of insurance that are out there. It's unbelievable. You can have insurance for your pet or for a plant or something like that. There's insurance for everything. So I'll get into that in a little bit later. But I want to basically explain to you guys that insurance is basically covering yourself so that if something were to happen to you, that you don't financially get hit with the big bills that may come to you, and you might have to pay out those as a premium. So you basically pay a smaller amount of insurance to the insurance provider in the event if something were to happen to you, that insurer will cover your expenses for a temporary time period or whatever the contract allows for. Now, there's different types of effects. Spending time in the hospital that you might be insured for. The cost can range from very small to very large. Obviously, you don't want to get insurance for something that's very small, like say $50 or whatever. I mean, you could, but why would you want to do that? You know what I mean? Like insurance is mainly for big ticket items like health insurance, car insurance, life insurance, things of those nature, something that are big, things that could really impact or make a big dent in your checking or savings account. That's what you want to insure against, so that those things don't wipe you out or make you go bankrupt. So it's basically risk management, and you want to mitigate those risks, make those risks, as little as possible. And by mitigating your risk, you're evaluating the amount of things that are going on. Like if you're just, if you skydive a lot, you want to have a high risk ratio, so you might have a lot of death insurance waivers and things of that nature. But if you're maybe walking the dog down the street or something on a regular basis, your risk is quite low. I mean, you might get hit or struck by lightning or something like that, but your risk is quite low from having something bad happen to you in that sense. Now, when it comes to somebody who like some key terms, I guess you would say, to know or acknowledge about is the underwriting process. Here's one word: underwriting. What underwriting means is that somebody's going to evaluate your risk. So if you don't know what you feel like, are you risky, or are you an aggressive driver or something like that? So somebody is an underwriter, so will evaluate your risk to ratio tolerance, and say, okay, well, if you're dealing with, sharp knives all the time and you're a juggler, well, your risk might be a little higher. Well, if you're, cooking as a cook, maybe your risk might be a little bit lower because you're not dealing with juggling knives. You might be just cutting things, and the risk might be, smaller injuries. You might cut your finger, you might get burned or something like that as a chef, but the risk is relatively low. So that's what underwriting is. Underwriting is the process of writing out what your risk to ratio is for you or somebody else, type of a thing. So that's underwriting. When it comes to bounding a contract, meaning you are bound to the contract. Whatever the contract says, you are bound to it. So it's not anybody else, it's you. Whether you decide you want it to be bound to your pet, whether you want it to be bound to something, it sticks to something. It's bound to it, okay? The insurer is the person who's offering the insurance to you. So that would be, say, like Geico Insurance, Allstate. I don't know. There's so many different types of insurance companies that are out there. Those are the ones who are issuing the insurance for a low flat rate. Now, those different insurers have different rates because they're all in competition with one another, but they also offer different types of insurance that they might be better. Allstate is probably more for homeowners insurance versus health insurance, but they probably have it too. So those are types of things to think about, and finding out which ones are those. I'm going to try to help you out, but you really need to speak to somebody who is an insurance professional in regards to trying to select which type of insurance you want to have for your personal coverage. Now, it ranges drastically. There's a huge array of it. And insurance is for everything, and they have everything out there, whatever they can do to get your money from you. And in case an event happens, flood insurance, fire insurance, tornado insurance, whatever it may be. There's so many different things. It's insane. Now, that's the insurer. You are the one who is insured, who is going to be the one who's going to be having that bound contract to you or to another item. Whether do you want your car to be insured? That could be something. It's not really attached to you, but it's your car. So if anything happens to your car is going to be fixed. You won't have to pay the premiums for that. You'll have to pay the basic minimum down payment for, what is it? Just to get your, say you get into a car wreck, for example, you can pay the basic minimum of like $200, and then the rest will be covered by the insurance to replace the damages. You pay, a copay, for example, when you go for health insurance, you pay the $20, and the insurance will pay the rest of the bills for, say, cleaning your teeth or something like that for dental insurance. So those are like a copay. It's a smaller amount that you would pay, and the insurance will then kick in to pay the rest. Now, different companies offer different types of copays, whether it's $20, $100, $500, up to $1,000, or whatever the limitations are, and then it'll kick in. So the main thing is insurance is covering you for high risk things, big ticket items, big items that are more than like $500, $600, $1,000, $100,000 damages, stays in hospitals, etc. There's something called a rider. A rider is basically something that adds on top of your insurance policy. So say you want to cover a table, for example, for nicks and dings and this and that, so it doesn't get scratched. Well, you can add something else on top of that called a rider, which will cover if the table burns, for example, it'll protect it from that. Now, there's also a thing called insurance umbrella policy, which if you don't want to cover your main table here, for example, you can cover everything on top of that insurance. It'll cover the entire policy as far as your tables, windows, glass, plants, things like that. It's an umbrella. It kind of covers everything in a nutshell, and that's how that umbrella policy will work. The other thing that is the main popularity thing is the two types of insurance. There's property and casualty insurance. Property protects your property, and casualty insurance protects your life. Anything that happens to you or a pet or any kind of animal, you will be covered for that. So those are the main two types of insurance that are out there. There's many different types of insurance that are out there. There's auto insurance, there's homeowners insurance, there's health insurance, disability insurance, long-term care insurance, types of life insurance, there's whole life, universal life, variable life. Oh my gosh, the list goes on and on. It's insane for the amounts of insurance that are out there. So be aware, and I'm going to try to narrow these down for you, but the main two types are health insurance, auto insurance, and casualty insurance. Okay, those are the main three types that are important. So you definitely want your health insurance. You want to make sure if you're driving or operating an automotive vehicle, you want to have auto insurance. And then again, property insurance. So in case your place burns down or your homeowner's insurance. Hey guys, welcome back. Sorry about that. My phone actually stopped recording for a second. I had to jump back in. All right. So besides the insurance, property, the casualty insurance, and the health insurance and or auto insurance that you might cover as the main three, you want to make sure that you're not underinsured or overinsured. Underinsured basically means that you are not covering yourself for the things that could happen to you. If an event does happen to you, you're going to get slapped with a huge bill, and you don't want that to happen, so you might be underinsured. So say you're going on vacation and you didn't plan on hurting yourself, and you break a leg or something like that, or an arm, and you're not insured for that on your vacation, something that could significantly impact your savings or checking account, and put a dent into your financial obligations to repay that. So that might be somebody who's underinsured. Now, overinsured means you're paying out every single month lots and lots of money to have everything covered. You got the umbrella thing, you got insurance for your car, your health insurance, your property casualty insurance, you got life insurance out, everything. You're insuring fire, wind, water, floods, everything is insured. It's you're paying thousands of dollars a month just to be insured, so in case something did happen, you're covered. But the thing is, a lot of times those things don't happen. You know what I mean? I'm not expecting a flood to happen here where I live, because there's no chance for really of happening unless it's an act of God or something crazy goes on. But I'm not going to buy flood insurance where I live, because it's not really going to happen. So I wouldn't want to pay that out of pocket for that insurance to have happen. So those are some things that you got to think about. You don't want to be underinsured, you don't want to be overinsured, but you want to be insured enough for the fact that if something were to happen to you or to your property, that those things can be replaced. Okay, so those are the main things that you got to worry about with an insurance. Try to keep your premiums down to a bare minimum. Obviously, insurance you want to pay up in full if you can throughout the year. Pay it all in full, because you'll usually get a discount by paying upfront and paying in cash, or paying all at once for the entire year. Usually, insurance companies will offer you a discount up to $200 or $300 off the main retail value by paying everything upfront in one big chunk. So that's something to consider, because paying with cash is king, right? So that's something to think about. If you can't do that, pay semi-annually, meaning twice a year, every 6 months, in double chunks. If you can't do that, then do monthly, or bi-monthly, or something of that nature, where you can pay on a regular fee, and it'll try to mitigate your expenses when it comes down to insurance. This is the last take. This is the third time my phone has crapped out on me, but basically I'm going to explain to you some examples of insurance when it breaks down: health insurance, car insurance, life insurance, etc. in future episodes. So stay tuned, and thanks for watching.